Hi, and welcome to this episode of The Insurance Experts. My name is Marc Glickman. I'm an investment actuary and a long-term care insurance expert. It's my pleasure to have on the line Steve Cain, who's also a long-term care expert. We're going to do a little role reversal today where Steve's going to interview me and we're going to talk about today's interest rate environment and how that affects insurance companies. Thanks, Steve, for joining us today.
Joining you. I'm the one who grabbed you and said, Mark, I need you. We need your help. So as a long-term care expert and specialist, we all know what's going on in the world with COVID-19. And we've had a lot of clients that have called us and asked, are these insurance companies going to be okay? Are they going to be able to pay future claims? Are they in secure financial standing? And then a couple of days ago, there was an article in the Wall Street Journal about COVID-19 being a double threat for insurance companies. One being death claims, two being the record low interest rate environment. So I wanted to ask the actuary, what's this doing to insurance companies right now? Are they okay given interest rates where they are today?
Right. I think everything's tense right now, but if we kind of think back and we think about what are the fundamental things going on, we're talking about life insurance companies. Usually they're A or A minus rated companies. They have what I call fortress balance sheets. They have a lot of surplus set aside. They hold dollar for dollar reserves for whatever claims that they have to pay out. And so we look at this, it's mostly volatility. I guess we can first talk about the asset side of the balance sheet for the insurance companies and the impact of low interest rates, right? Which affects new money investments going forward. But remember, the insurance companies have a lot of money that they've already invested, and the value of those investments have actually gone up, right, when interest rates go down. In addition to that, they hold that money at book value. Okay, so they don't have to mark to market or reflect the volatility that's happening in the market in terms of their financial strength. And that allows them to weather different environments. And that's one of the nice things about how the regulatory structure is set up, is it doesn't create a lot of stress necessarily on the asset side. Now, what can create stress for insurance companies from an asset perspective is credit risk, meaning companies that go bankrupt and then they don't pay their bonds, and then they have to reflect those defaults on in terms of what surplus they hold. But again, we're not seeing necessarily waves of companies defaulting yet, but that's something to keep an eye on and make sure the companies don't have exposures to some of the larger companies that are not doing well because of the environment.
Got it. So, from your perspective, even if there's going to be continued volatility over the next several months, these insurance companies are still in good enough standing to pay future claims for long-term care?
Yeah, and or for life insurance. And, I kind of look to Warren Buffett. He was comparing today's, situation with COVID-19 to what happened during the financial crisis and what happened in 1987 with the stock market crash. And he thought this was not as bad. There were a lot of other financial things going on during the financial crisis that were impacting insurance companies in different ways. So I really don't think that this is going to create an extreme amount of volatility for the insurance companies directly. But even on the liability side, kind of as you'd mentioned, probably even the impact of elevated death claims is not going to impact them too much. One is because a lot of the larger companies are selling cash value life insurance and they're already holding reserves because, policyholders can cash them out. So it's just maybe a little bit of an elevated level of what they're holding above their reserves. We're also not seeing that significant number of deaths right now, right? People are concerned that it might happen, it might spike up, but we're not seeing that really relative to like the seasonal flu. It really is not yet impacting them. And then finally, the people that are potentially at risk are people that are of older ages. And of course, insurance companies assume that there's a higher level of mortality for people of those ages anyway. If it were happening to people who are younger ages or on term life insurance, to kind of the primary breadwinner during their working years, that type of thing, if that was elevated, then they might end up paying a lot more than they expect to pay, which is, of course, what really impacts the insurance companies.
So let's say we see continued volatility in the marketplace. Do you think insurance companies are going to change products, change pricing, or reduce guaranteed interest rates?
Well, I think they've been fairly conservative. Today's interest rates are so low relative, for the last 10 years, they've been low. So there's really not too much they're going to do as a lever there. It's going to be relatively modest. I think if there was continued stress, like we saw in the last financial crisis, the regulators would probably come together and provide some relief for the companies as a whole. So what you're really looking for is maybe there might be a one-off insurance company that's taken an elevated level of risk in some particular area, either on the asset or the liability side, and that's the one they're going to scrutinize the most. But I don't think they're going to make major pricing changes or product changes based on this, unless something happens that changes the statistics that they're using for pricing. And I
Right.
don't think anything that's happening right now is really going to that magnitude.
Well, Mark, you made me feel comfortable in making recommendations. Appreciate your time.
Yeah, thanks so much. Appreciate you interviewing me.